Okay, now we're going to move on to AP 11B here in Chapter 9. And in this problem, we have a bunch of different transactions that occurred and purchases and sales, etc. And we're going to journal those in. And once we get that done, we're also going to do a little calculation to figure out our gross profit and gross profit margin for the month as well. Okay, so first thing I'm going to do is just reorient those. Your version you look at will probably already have those oriented, aligned in the middle there, if you will. So you might not have to do that little step as well, but just realize that's kind of a nice to have there. Okay, and so January 1st, we sold merchandise on credit to Merrill for $15,000 with some specific terms. And so again, we're going to do accounts receivable. Remember, we're always basically using accounts receivable in this chapter, for all these inventory transactions between wholesalers and the vendors and the suppliers, etc. Okay. And then we have sales revenue that we are recording related to the fact that we made a sale. I'll link up there so our debits and credits match. And we'll say record sales. And what I like to put it is, let's say customer Merrill, and then let's put the terms in here because this is kind of handy information to have later when payments are made and all that kind of stuff, so that we know how to, if there's a discount, etc. But let's do put record sales. Now let's just leave that. I kind of like just that conciseness. You can tell it's a sales transaction there otherwise. Okay. And then remember, for our sales transactions, we're going to have cost of goods sold. So here we can just say record cost of sales. And remember, our cost of goods sold is going to be our debit, and our merchandise inventory is going down. Expenses going up, our inventory asset goes down because we sold it. We're giving it to the customer, selling it to the customer, I should say. Sales revenue is going up, the credit, and our AR asset is increasing as well. We're going to collect that cash in the future. And then related to that, depending on if they pay us within 10 days, we're going to collect less cash because we're offering them a discount if they pay us quickly within 10 days, basically. And then 15,000 is not, it tells us the cost of goods sold was 8,500. Okie dokie. So that was recording our sale there for that first one. And then we paid $50 to ship the goods to Merrill. And just a reminder, when you see shipping expense related to the receipt of inventory coming into you, if you're buying inventory and you paid that shipping cost, it's going to increase your inventory value. But when it's us as a seller just selling the inventory and paying the shipping expense, we just record that as shipping expense. So it doesn't do anything to the inventory value specifically. And I think we're just using cash here, and it doesn't say on accounts payable or on account or anything like that. And we'll just say paid shipping costs, and it was $50. Okay. So this is just kind of a cost of doing business for us at this point. Again, like I mentioned, if we're receiving inventory, buying inventory and receiving it and paying the shipping fees, then we would increase our asset for that amount in addition to the cost just paid for the inventory. But when we're paying to ship the inventory out to the customer, we're just going to take that as an expense. So it'll be just an expense that we have this period on the period cost, essentially, as opposed to kind of a temporary account. It'll close, etc., and be on the income statement. Okay, let's see here. Where are we now? We're on that was January 5th. No, that was everything. It was January 1st. So now we're on to January 5th, and I'm just copying down the format, and then we'll update the content of the journal entries as we go. So on the 5th, we purchased inventory for $12,000 on credit from Outdoor Experts. Terms of 1% if paid within 10 days, and net 30, so I have to pay us net 30. So actually what I'm going to do is just take these two journal entries here, because they're going to be very similar. And in accounting, if we can find ways to make things faster, that's really great. Oh, you know what? Never mind. Sorry. I just realized that was this is a purchase transaction we're doing. I thought it was a sales transaction again. Sorry. So we are purchasing the inventory this time. So merchandise inventory will go up by 12,000, and accounts payable will be our credit. And we're going to say inventory purchase. We'll say, we'll just put the outdoor experts is who we're buying from. And let's say vendor, kind of to match what we did above where we said customer. We'll say outdoor experts, and then we'll say the terms 110 net -30. So we offer a discount here, and now we have a discount that we can take care if we pay within 10 days. So it goes kind of both ways for purchasing and selling. Okay. And then we are Wild Wilderness Supplies. And so like I was mentioning previously, is basically just what I was saying, is for January 5th, we paid the $25 to increase or to get the inventory to us. We're paying that just in cash. And I will say shipping costs, and we'll just say inbound. Let's update this. I have some consistencies, kind of nice. Shipping costs, and we'll say outbound. So when it's outbound to a customer, we just record it as an expense. But if it's inbound and it's going to be inventory we have in our warehouse, we can sell in the future, we're going to debit not expense, but instead we're actually going to debit that asset account. So it increases the value of the inventory for inbound shipping costs. Okay, on January 8th, Merrill returned $1,200 sales price of merchandise purchased on January 1st. The cost of goods sold was $800. The inventory will be resold. Okay, so we're now getting the inventory back from a return, and I'm going to steal this, copy and paste in this journal entry, because when we get a return, it's very similar. Oops, I did that wrong. Sorry, let me undo that. What I want to copy is these two journal entries that are the ones related to our sale, and the return is quite similar to a sales entry, and so we can kind of use that as a template. And I think we basically just reverse everything, but we don't reverse sales revenue. We use a special contra revenue account. So I'm gonna link up to the previous journal entry just to kind of help understand. I'm gonna delete that, but reverse everything else. So it's just, instead of debiting accounts receivable, we're crediting it. So it went up here, but now it's going down, right? And then we're going to debit merchandise inventory because we got inventory back in our warehouse. And we're going to credit. So we're just doing the opposite when it's debit or credit compared to what's down here, except for we don't do this. We don't debit sales revenue. That if we did all this, that would be the exact opposite of this series of the two entries for the sale. But we don't do sales revenue. Instead of directly debiting sales revenue when we have returns, we have this account called sales returns and allowances. And again, this is a contra asset account, so we take this account here and reduce it against sales revenue. So it has the effect of reducing revenue. But we keep those two things separate for analysis purposes and transparency, to be able to see how much returns we have in a given period versus how much sales we had, etc. Okay, and so they didn't return all this. We're not going to use these same numbers here, but they returned $1,200 worth. So our returns and our AR goes down by $1,200. We're not going to receive that $1,200. So it was a total of $15,000. But then since they returned a portion, it's not going to be $15,000 anymore. It's going to be $13,800 of AR. And then the inventory that came back, it told us was $800. So now we have inventory back on our shelves of $800 that can be resold, and our cost of goods sold goes down, where at first it went up, by the full amount, but now it's reduced down because they had that return. So it'll be a little bit lower because that portion of the sale didn't really happen. At least it was returned. Okay, so now we're on to January 12th, and in this entry, some of the merchandise purchased on January 5th. So this was us buying inventory here for ourselves on January 5th. And we were saying some of it was purchased, was the wrong size. We decided to keep the merchandise in exchange for a 25% allowance on the purchase. And allowances are not, so we can't take the allowance on the shipping cost, but just on the 12,000. And so essentially what we're going to do in that instance, copy this in. And so remember, here's our accounts payable. This is the full amount we would have owed with no other allowances or differences or anything. And when we come down here, so I just pasted this in, and we'll update here. Oh, I did that. I need to update these. This was all, the return was on the 8th. Make sure I got my dates in here right. This was both on the 8th. Paid for the cash. I think this is the 5th. Yep, both of these are the 5th. Oh, shoot. I'm like, wait a minute. Something looks weird. Sorry, I must have done that twice. So let's delete that out. And, okay, here we go. So we've got the 15,000, the 8,550, the 12,000, the 25, 1,200, 800. And now we're going to look at an allowance situation here. So this happened on the 12th. And so this is the original, purchase of inventory inbound. And then, like it says, some of it was the wrong size. And so we're going to keep the merchandise. So we're not going to send it back. And the vendor will give us a discount for 25% of the purchase price if we keep it, because they'd rather have us keep it anyway. It's a pain to get it returned and put back on the shelf, and they have to make sure it's okay to resell it, and look at it and analyze it to make sure the inventory is not damaged or anything. And allowances are not, so ignore the inventory part. But what we're talking about here is 25%, so we can just multiply 0.25. And essentially we're going to reverse a portion of that accounts payable. So originally accounts payable went up, credit by 12,000. Now we're going to reduce it by 3,000 because they gave us an allowance for that. They can say, you can pay us less, that's fine. And then accordingly, our merchandise inventory, which would have been 12,000 if we paid 12,000, is now going to also go down by 3,000 because the actual amount we ended up paying for all this merchandise is only going to end up being 9,000 in total. So those two things are recorded there. I think I need to update this here. Let me make sure I've got it was Merrill. Doop. And shipping costs. Okay, and that was the, let me just update this. So this was inventory return from Merrill. And we'll just say, that's enough. That's good. Okay. Right, and our explanation here then will be allowance provided by outdoor experts. Okay. I'm going to take off the highlighting. I just wanted to highlight those so you can kind of see that they're related to the same set of transactions there. Okay. So this was merchandise, for Merrill coming back to return. It was the customer. Great. Okay. So now we've got our allowance provided by outdoor experts related to our January 5th purchase. Let's see what happened next. Now we received payment from Merrill for the January 1st sale. So here's Merrill, right? We said Merrill, you can pay us 2% less if you pay us within 10 days. So by the 11th, right? But they're actually paying us on the 15th, I believe, right? Yep, received payment. So they don't get their discount because they took too long to pay us. So cash in and accounts receivable, just like we've always basically done. And we're going to say payment received from Merrill. Let's delete those out. Okay, so the amount of payment they're actually paying us at this point, right? It would have been $15,000, but they had a return of some of the merchandise here. So it was originally $15,000, but then we reduced it by $1,200 because they returned some of the inventory. So what we're basically receiving in cash at this point is $13,800, which would be the outstanding amount of receivable that we were owed by Merrill at that point. Okay, so we're on to the next transaction, I believe. Yep, all good there. Okay. So again, let's just keep copying and pasting in here. And what happened on the 18th? On the 18th, we sold merchandise on credit to Forest Outfitters for $5,000, so on and so forth. And so another sales transaction. So I just copied and pasted this transaction, but actually I'm going to go up and again steal this one and just use that to paste in and do some updates here. And it was Forest Outfitters because it's just nicely formatted, and we got our two different, 4 distinct lines, kind of the combination of these things for our sale. And so now we've got the customer is not Merrill anymore, but Forest Outfitters, and it's $215, so they get 2% if they pay us within 15 days, still net 30. It was $5,000, and the cost of sales for us on this one was $2,600. Okay, so that's great. We had that payment, that sale, and we have some more receivables now. And then on the 23rd, we paid for merchandise purchase from Outdoor Experts on January 5th. So this is us paying for inventory coming in. Let me put 1-23, January 23rd. Okay, and now cash, and we got this one. I'm just going to delete this out and just kind of actually start fresh because we need to figure out. It might not be a 2-line entry. It might be a 3-line entry. And I'll show you that here if we're able to take a discount because we paid within the discount period. So again, we're paying on it was January 5th, and they said you can have a 1% discount if you pay us within 10 days. Is that the right one? Forest Outfitters. Oh, sorry, I'm thinking. Yeah, okay. Outdoor Experts, right? Yeah, Outdoor. Okay, sorry, I was getting mixed up there. So this was our purchase, and yeah, we don't get to take the discount, right? Because we would have had to pay within 10 days. They had 110 net 30, so shoot, we don't get the discount. We took too long to pay, but that's is what it is. Okay, so accounts payable is going to go down. Do my little format painter to make that look unitalicized. And then actually I'm going to do my format painter. Oh, I don't want that. Undo. Format paint these 3 cells because it's going to be very similar. We have cash being paid and decreasing our accounts payable to Forest Outfitters. Outdoor Experts. And at this point in time, we owed Outdoor Experts originally $12,000, but then we not returned, but they gave us an allowance because there was problems with it. So we're going to take our $12,000 minus the $3,000 allowance they provided us, and that brings us down to a payment of $9,000 owed, which I think we kind of mentioned that when we were doing that previous entry. So that's great. And then we'll put our explanation in. Say payment to Outdoor Experts. We'll put January 5th purchase. Okay, We're getting close. That was the 23rd. Now, on the 26th, I got to make a little more space here as well. On the 26th, what happened? We granted Forest Outfitters a 20% allowance. So now we're granting the allowance because there was a defect in the product that we sold to them, unfortunately. And this was from the 18th. So here, the Forest Outfitters. I'm just going to highlight this while we're looking at doing this new entry. And what we're going to record then is, again, a reduction of our accounts receivable. I'm going to just do that one first. So we're basically, reversing our original accounts receivable or reducing it really for us for a portion. So 20%, so times 0.2. So they owed us $5,000, but some of the merchandise was defective. So we said, hey, you can just pay us 20% less if you keep the inventory and, hopefully keep buying from us. And so they said, okay, so our receivable, the amount we're going to receive from the Forest Outfitters went down by $1,000. Right? Debited increased asset by $5,000. Now we're reducing it to give them an allowance. And reminder, we don't directly reverse sales revenue, just like we talked about before with sales. We use this sales returns and allowances account instead to represent and be a contra revenue account to offset sales revenue. So we basically are, because it comes to the accounts, we kind of reverse these, because the accounts receivable is now being credited instead of debited, but we don't necessarily directly reverse the revenue part, but it will be reduced in total by the contra account. For example, I'll just show you real quick how that looks on the income statement. Essentially, we would have sales revenue, and then we would have less sales returns and allowances, which would, as a contra revenue, that means it decreases it, right? So we would have 5,000, then we would have minus 1,000, which would mean our total net revenue would be 4,000. So we are reducing sales revenue in essence and kind of reversing this for that 20% portion, reducing sales revenue, but we do it in kind of a roundabout way using that contra account basically. So just something to keep in mind, just kind of for illustration purposes. And we'll work a little more with that later with the returns and allowances contra revenue accounts. But here we are. We are provided, let's say granted, just the same terminology, granted allowance to Forest Outfitters. And we'll just leave it at that. And yeah, 20% of the 5,000. All right, so the last entry on the 31st says that we received payment from Forest Outfitters. So this is them, paying us. And this is on the 31st. So we get cash coming in. And so, and let's take a quick look here. So we're offering a discount to Forest Outfitters. This happened on the 18th. And we said, if you pay us within 15 days, you can take a discount. And so if it was on the 18th, we add, 15 days to that. Well, that puts us, it would have been into February, basically. So they had until like February 2nd or something like that to pay us and still receive a discount. They're paying us on the 31st, so they are within that discount period. So that means we got to do one extra thing, and I'm going to add a line there for this purposes. And what we're going to do, we always want to get rid of the full amount of receivable. So they owe us, originally it was 5,000. Then we granted them an allowance to reduce the receivable to 4,000. Let's delete that piece out. So they had a total receivable. We had a receivable on our books showing that we were going to receive $4,000 from them at the point that they paid us. And so now they are paying us. But they're going to pay us less than the full amount because they paid us within the discount period, and they're going to get a 2% discount, right? So the cash that we receive is going to be 2% less. So in other words, it would be 98% of the total is what we're going to receive. So we could say 98% times the 4,000 is 3,920. And then again, we're going to use a contra revenue account, but it's called sales discounts, to note that, as the difference there of $80, to reflect that we reduce, we let them, because they paid us quickly, we said, hey, you don't have to pay us the full amount. And then this contra revenue account will decrease our total sales revenue eventually. So it's just basically a reduction in our revenue as in effect once you add all that together. So yeah, they paid us quickly. So we said, you owed us $4,000, but we'll let you pay $3,920 instead because you paid us within 15 days. And that's how we record that. So we got the cash, we recorded a contra revenue, sales discount, and then we got rid of the accounts receivable off our books because they're fully paid up. And we'll say received payment from, which one was this? Yeah, this was Forest Outfitters, right? Forest Outfitters. And we'll just say discount, just to indicate that the discount was taken. And that's all our journal entries there. So now there's one final piece of this problem to do. And that is the portion here where it asks us to analyze. Oops, I kind of covered it up there. Let me pull that back up so you can see it. It asks us to calculate. Sorry, let me just get this good. Calculate Wild Wilderness Supply's gross profit margin for the month. So what we need to do then is go through and essentially pick out, all of our different components to get gross profit and then figure out gross profit margin from that. Okay, so this is for all of our sales here. So let's take all our sales revenue. So that was our first sale. And let's just go through and look for all of our sales. Here we go. Wait, was there any more? Nope, that was the next one. So then we had, plus equals that first revenue plus another revenue there. And I think it was just the two, Forest Outfitters and Merrill, I believe. Yep. Okay, so that was total sales revenue for the month was $20,000 from those two entries. Here's our contra revenue accounts. And so we'll have those as negatives. And this will be sales returns and allowances. So let's look for all those. Here's one. And then a second one we had, I believe, one more there. So we had $2,200 for sales returns and allowances. And finally, what we just calculated, the discount there, was $80. And so again, these are both contra revenue accounts. So we're showing them as negatives because they reduce our total original sales. So then we get net sales. That's the term we use to say revenue minus returns, and discounts, etc. So after we figure out things coming back and allowances, yada, 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 our net sales was $17,720. And let's look at our cost of goods sold now. So here's cost of goods sold. And that was that one. There was two transactions. Okay, here we go. It's some returns though. So we need to make sure that we subtract the credits from the debits. And I think, is that everything? We have to be missing something. And I'm actually going to show you guys a little trick here. This is going to be kind of cool, I think. So I'm going in and copying that word cost of goods sold because I want to highlight every time that it says cost of goods sold in our general journal here. So then I highlight the whole place I want to look. And then I'm going to click this button called conditional formatting. And let's say new rule. And I'm going to say format only cells that contain specific text. And we're going to paste in that cost of goods sold text. And then we're going to click format. And we're going to go to fill. You can click any color, but let's just do yellow highlight. Click OK. And so now it highlights every cell that has cost of goods sold listed as with that terminology. So that's just kind of a nice way, just a little Excel trick for us to know, a handy way to pick out data when you're trying to go through. Okay, so debits are increases, the credits are decreases for returns, and then a debit as an increase. And so we get 10,300. Okay. Okay, so my video hit the time limit, so sorry if that just jumped right now. But I took off the conditional formatting. I believe that was shown already in the video, but I just went, if it wasn't, I just went to conditional formatting and I just set clear rules from the entire sheet, and that made the highlighting go away. But that, like I mentioned, just a cool way to highlight any specific terminology so you can pick it out easier than having to try to use your eyesight to find everything. But at this point, we've got everything. We've got revenues, returns and allowances, cost of goods sold. And so gross profit is net sales minus cost of goods sold. And so that gives us 7,400. And just to be consistent with the positives and negatives, let's have that be a positive and then just say net sales plus the negative, which is minus there. It's just a little easier to see, I think, in terms of how what are we adding and subtracting. And so our gross profit for the month, after considering the cost of goods sold, was $7,420. How much would that be for the year? About close to $90,000, $89,000. Just kind of out of curiosity. Okay, so we had two sales, and then our gross profit margin. The formula for that here is that we take gross profit and we divide it by our net sales amount. And so basically what we're saying with that calculation is that so we have, and let's do this in a percentage kind of format there, 4.42 or 42%. So in other words, out of every sale that we make, 42% of that sale is basically profit at that, when we figure in the average cost of goods sold. So if you take gross profit times, or divided, I guess, by 42%, you get the net sales amount, right? So that's pretty good profit. I think, it would depend on what industry you're in, but yeah, like I said, for every dollar of sales that you make on average, right? Because you might have different costs of sales depending on what the item is or when it was purchased. But on average, you're keeping 42% of each sale as profit after figuring in the cost of goods sold. So important metric to know. And one way to use it is to kind of compare yourself to others within your industry. And you can see, like, are we paying too much? Are we charging too little? Maybe too much, maybe we're overcharging, and maybe that might lead us to lose customers or something versus other competitors in the industry, so on and so forth. So, yeah, cool. All right. Well, I hope you enjoyed this walkthrough here of the problem. It's kind of a lengthier problem, like there are some in this chapter. Covers a lot of ins and outs, inbound, outbound, all the different kinds of inventory transactions. And thanks for following along, and I'll see you in the next video.